What is going on, everyone? Welcome back to a brand new video where today we're going to be focusing on interest rates, Euro USD, dollar index, stocks, and maybe a couple cryptos that might be going up in the near future. Now, before we begin the video, I want you to leave a like right now. Just go give me a thumbs up on a video, hit the subscribe button. Got a lot of videos coming up. And today's video is sponsored by Game of Life Trading, a community where you can start trading smart money concept, liquidity inducement, supply and demand, support and resistance, anything you want, man. This community is completely free, ran by me and my partner Henry. Oh, Henny. And yeah, we're gonna teach all kinds of things. We do live trading, we do signals, and we do just free chart markups. A whole bunch of communications. Link is in the description. Let's get right into this. So, oopsies, wrong chart. There we go. Today, we're gonna start with my analysis of dollar index. But first, I want to start off super simple. We're gonna go in the higher time frame, and we're gonna start by looking at the 1 month time frame. Boom. It is now September 2nd. August is no more. So, what does that mean? Well, we got to look at our monthly chart. What does the monthly chart say? The monthly chart tells you everything only once the previous month has closed. Now, we can't use the monthly chart because the month is the same as the week, which is pretty much the same as almost the daily because, like, if you look at it, it's pretty much the same thing. Oh, my bad. Let me show you what I mean. There. This is what we have right now for the month of September. So we can't really use the monthly chart for the month of September, but we're going to base it off of previous month data. So what do we got here? Well, we got a very, very strong bullish candle indicating what? Bullish intention, maybe? Possibly. But I want to go ahead and first start with the obvious. This low right here. Now, this low can be noticed as a whatever you want, but it's previous month high. No. The month before that's high. This is the previous month. Imbalance is what I meant to say. So the imbalance here is important because healthy price action revolves around this principle right here. What do we need and what do I mean? Well, first, let's start. Look at this. Screenshot this in your brain right here. This whole area. Screenshot that in your brain, and we're going to move down to right here. So we got last month, the new month. And what do we have between this month and the next month? Well, we have what's imbalance here, right? Right when this candle starts. Right when this candle starts, we got the same thing. We have what's called an imbalance fill. Boom. The next wick comes up, fills the imbalance, then continues to attack the sell side. This is how you want to be using your imbalances. That's why I don't really trade the FVG itself, because in this case, like, what do? You take a sell, maybe I'm just trolling a little bit. Maybe you got to refine, of course, but you take a sell above here, you know what I mean? It's not very ideal in my opinion, but I'm saying it's doable, possible. But my point is, this is what we've seen here as well. High of the month before, last month, new month. Comes down, fills this imbalance, reacts off of here, which is called a hidden base. I teach all of this in the community, link in the description. And then price flies. So I would like to believe we have a similar scenario here. So this imbalance here just needs to be filled. I'm going to just draw it as a line. And I would love to see price dip in here and then just boom. You know what I'm saying? That's reasonable. I would love to see that. Is it possible that it goes the complete other way? Yeah, anything's possible. But reason to believe we're going that way starts to make more sense as we dive deeper into the data. So we're actually gonna go. I want to make this a little small, shorter video, but we're gonna go in the 8 hour, and I just want to dive a little. I dive a lot deeper to in the game of life community, but basically, what we got here is liquidity inducements. A high here, which also is a break of structure. This is the last down close candle. If we go on the daily, is it the weekly even? Nope, definitely not the daily, but maybe go on the 3 days. Yeah, we go on 3 days. So we're just gonna mark this entire area here. Here, just give me 1 second here, guys. Let me lower this just a tad bit. There we go. Back in the mix. Technical difficulties. We are back. We're back. So I would love to see price react something along these lines here. Now, if we go back into the daily, I'm going to mark this area as a liquidity inducement. I'm going to mark this as an inducement as well. So this would make sense now, right? If we look at it simply, very, very simply, do we have enough structure on the left side for a break of structure? No. So it's likely that we do something like that, right? That would make sense, and that would look very reasonable. Now, what do I want to show you guys? Well, we're going to look at the Fed Powell speech. Remember this guy? He spoke on a Friday, and it caused a lot of ruckus in the charts. Well, when Fed Powell spoke, in short, all he said was interest rates, we're going to drop. Interest rates were going to come back down from where they are now. Well, Tanner, where are they now? Tanner, where are they now? Well, I'm going to show you where they are right now. So interest rates, if you guys don't know, have been shot up pretty significantly during COVID. So this is what we got right now on the effective federal funds rate. We're at 5. If you type it Fed funds in TradingView, you're gonna have this chart up, and it's a very useful chart for you guys to have. The federal funds dictates a lot of things. It dictates the dollar, and it dictates the stock market. Well, the bond market, which and then hits the stock market. So let's compare some charts here. So we're gonna compare first. For those who trade NASDAQ and all that other stuff, I want to go ahead and show you guys this data right here. Really cool stuff to come right now. It is going to be, we're going to go first, we're going to take the 30-year bond on a weekly, and we're going to compare it. So you can do that. If you hit the 30-year bond, you type US30Y right here. And then remember the Fed funds one? You right click and you click add Fed funds to compare. Boom. And you can do this magnificent contraption where you then zoom out to the maximum potential. And then you have yourself a very interesting chart. What the heck am I looking at here? Why does this look so similar? Somebody explain this to me. Well, because they're correlated. So we got the bullish, the purple here is the federal funds, right? Mr. Fed Powell telling interest rates to go up and all that. And then in the stocks here, we have, not the stocks, the charts here in the candlesticks, we got the 30-year bond. Now, what are bonds? Bonds are basically government issued stocks, investment paths where you can basically invest in the government, and the government will guarantee you return. So it's pretty cool. The return is not this on the chart. This is on the right here. That's not right. It's about 5% or something like that every year, which is pretty chill. But we're traders. We do that every month. Anyway, as you can see, interest rates go up. There's a correlation. Interest rates go down. bonds go down, interest rates go up, bonds go up, interest rates go down, bonds go down, up, down. Now, they're not perfectly correlated, and that makes sense because the 30-year bond actually has more data points, and the interest rates is only every month. So you're not going to have as much, I mean, every month or every few weeks, not as many data points to look at, which is a little bit unfortunate, but it's close enough. I mean, this comparison and correlation is enough for me to say, okay, cool, we have a comparison here. Next, we are going to go to wait. Conclusion: interest rates affect the bond market. Now, what does the bond market affect? Well, we're gonna look right here. Boom, bam, pop. Stock bond correlation is an important component of portfolio allocation. It is widely used as an institutional investment. Wait, this isn't even the right one. Oh, yeah. They move opposite to one another. So, if we come back here and we look at NASDAQ, boom, right? NASDAQ has been rising. It has been forever rising, but it's not a very good comparison here. But if let's see if we can see something compare here. Can't really see, but they're like opposites. I don't know if we can see that, but you can see they're like opposites. It's not gonna show like the other chart because yeah, but as you can see, they're moving farther apart from each other. So it is fair to assume that bonds and stocks move opposite to one another. What does that mean, though? Come on, Tanner, man, explain this to me. Well, that means that, okay, well, we're gonna go back to the dollar index here. The dollar index is poised to go lower. Now, I'm gonna show you one example, and that should be enough to illustrate this point because it made a lot of sense when I was talking to one of my business partners who's sending me money from Australia. And I was like, damn, bro. January 2022, funds, the interest rate shot all the way up. Remember, January 2022. Remember that day, January 2022. And boom. Right here. January 2022. Interest rates shot up, dollar shot up. In correlation, Euro USD went down, right? January 2022. So, if we look at the data points and we say, okay, cool. Well, if interest rates shot down, went up, and Euro went down, or if interest rate went up and dollar went up. Now, why does that happen? First of all, we're going to backtrack a little bit. If interest rates are what the banks charge the other banks for transferring the euro to one another. So basically, it makes more money to send money in dollars than it does to send in other currencies if the rates are high. So the dollar, in simple terms, is worth more. So if you were to give me €1 before the interest rates were hiked, it would be a lot less expensive than to give me €1 when the interest rates are hiked and higher up, because the dollar is going to not be as expensive. So it actually convert at a better ratio in simple terms. So when we come back to the charts and we say, okay, cool, Mr. Fed Powell announced he's going to be reducing the interest rate. And I mean, if we're just going to do some simple chart work, I mean, we got a little order block here. I don't think that's how it works. But at least I'd like to believe we're coming back down to somewhere here. I honestly believe we're coming down here. If we come back down here, what does that mean for the dollar? Well, the dollar is going to get weaker. The dollar is going to get weaker. If the dollar gets weaker, right, like this little drawing here, dollar going down, euro going up. and it all ties right back into the end of what to the start of what we did. We are bullish on the euro. Now, directly from here, I don't know, but a little bit of movement here and boom would be reasonable. This is how trading is done, and this is exactly how I want you guys to look at investments as well. We want to look at the macro scale and combine it with the data entries and the data points to give us something, tangible to look at. If you guys have any questions, I want you to drop it in the comments below. Game of Life Trading, that's the sponsor of today's video. Link in the description. Join the Discord. Talk. We do live streams. We do a whole bunch of stuff in there. Free. We do have some one-on-one mentoring in there as well, but free knowledge is free knowledge. You would be a fool not to join. Without further ado, ladies and gentlemen, I would like you guys to leave a like, subscribe, and I'll see you guys in the next video. I hope you guys learned something valuable.